If you think professional money managers are smarter than a simple index fund, you're about to get a reality check that could save you thousands. Here's the brutal truth. Over 90% of professional money managers fail to beat a simple index fund over the long term. And the few who do, it's mostly luck, not skill. This isn't opinion. This is what decades of data show. But financial advisors keep pushing expensive funds anyway. Why? Because they make way more money from those fees. Let me show you exactly why index funds crush professional money managers. So, what are index funds anyway? An index fund is dead simple. It buys every stock in a market index and holds them. If you buy an S&P 500 index fund, you own tiny pieces of all 500 companies in that index. Apple, Microsoft, Google, Tesla, all of them. When the market goes up, you go up. When it goes down, you go down. No fancy stock picking. No trying to time the market. No genius fund manager making decisions. Most people think this sounds boring and stupid. Why would I want average returns when I could find a manager who beats the market? Here's why that thinking will cost you a fortune. But don't index funds just give you average returns? This is the first objection everyone has. Index funds are risky because you get all the ups and all the downs of the market. The alternative, according to financial advisors, is to invest with an active manager who can protect you from downturns and pick only the winning stocks. This sounds logical. It's also completely wrong. When the market crashes, do active managers actually protect you? Let's look at what happens during bear markets when stocks are falling. In some bear markets, about 50% of active managers beat the index. In other bear markets, less than 50% beat the index. Flip a coin, you'd get the same results. So much for protection during downturns. But here's the kicker. Active management adds a whole other layer of risk that nobody talks about. When you buy an index fund, you're taking market risk, the risk that the overall market goes up or down. That's priced risk, meaning you get compensated for taking it with higher long-term returns. When you hire an active manager, you're still taking market risk, plus you're taking active risk. The risk that the manager's bets will blow up in your face. Active risk isn't priced risk. You don't get compensated for it. You're just adding extra risk for no extra expected return. So, which sounds riskier now? What about picking only the good stocks? The second big objection. With index funds, you're forced to buy all the bad stocks along with the good ones. A smart manager only picks the winners. This sounds smart until you realize there's no reliable way to tell which stocks will be winners ahead of time. Here's a fun fact that'll blow your mind. From 2010 to 2017, while Google, Apple, Amazon, and Netflix were crushing it, Domino's pizza stock actually beat all of them. Guess who outperformed the tech giants? The goddamn pizza delivery company. Try explaining to your investment committee why you're betting the farm on pizza delivery over artificial intelligence. This isn't a fluke. Out of roughly 26,000 stocks that existed from 1926 to 2015, only about 1,000 of them were responsible for all of the market's returns above treasury bills. That's like finding a needle in a haystack, except the haystack is enormous and the needle keeps moving. Here's another way to think about it. From 1994 to 2017, global stocks returned about 8% per year on average. But if you miss just the top 10% of performers each year, your returns dropped to 3.6% per year. Missing the winners is catastrophic. And guess what? Even the smart managers miss them all the time. So do active managers actually beat index funds? Let's get to the real data that destroys the active management industry. The SPIVA scorecard tracks how many actively managed funds actually beat their benchmark index. The results are embarrassing for the fund management industry. Over 1, 3, 5, and 10-year periods, the vast majority of actively managed funds fail to beat their benchmark index. We're talking 80 to 90% failure rates consistently. But wait, there's more. Even the funds that do beat the index often don't beat it by enough to cover their higher fees. So you might technically win, but still lose money compared to just buying the index. What about the skilled managers? Here comes the third objection. Obviously, you wouldn't invest with just any manager. Smart investors only pick skilled managers. This is where things get really interesting. How do you tell the difference between skill and luck? Even over long periods, some managers will beat the market purely by chance. Academic research has studied this extensively. One study found that any persistence in fund outperformance wasn't due to manager skill, but due to exposure to basic market factors like company size and value stocks. Another study found that while there might be skilled managers, they're not skilled enough to cover their own costs. So even if they exist, they're not worth paying for. Want some real-world examples? David Baker managed the 44 Wall Street Fund to be the top-performing fund in the 1970s. He even beat Peter Lynch's famous Magellan Fund. Then for the following decade, his fund became the worst-performing fund, losing 73%, while the S&P 500 grew 17.6% per year. Or take Bill Miller, who beat the S&P 500 for 15 consecutive years, ending in 2005. Starting in 2006, he led the fund through 5 years of mostly awful performance before getting replaced. Were these guys skilled or lucky? If they were skilled, why did their skill suddenly disappear? Statistically, it would take 36 years of consistent outperformance for a manager's skill to be statistically significant. 10 or 15 years tells us almost nothing. Why does this keep happening? If the data is so clear that index funds win, why do financial advisors keep pushing actively managed funds? 3 reasons. Money. Active funds charge 1 to 2% annual fees. Index funds charge 0.03 to 0.2%. On a $100,000 investment, that's the difference between paying $200 per year versus $1,500 per year. Ego. It's way more exciting to tell clients about your genius stock picks than to recommend a boring index fund. Ignorance. Many financial advisors genuinely believe they can pick winning managers, despite decades of evidence proving otherwise. What does this actually mean for you? Stop trying to find the next Warren Buffett. Stop paying high fees for the illusion of expertise. Stop believing that someone can consistently outsmart the market. Buy a low-cost index fund, invest consistently, and let the market do the work. The S&P 500 has averaged about 10% annual returns over the long term. A simple index fund capturing those returns will beat 90% of professional money managers while charging you a fraction of the fees. Your job isn't to beat the market. Your job is to participate in it while keeping costs low and avoiding stupid mistakes. So what should you actually do? Start with a total stock market index fund or S&P 500 index fund. Vanguard, Fidelity, and Schwab all offer excellent options with rock-bottom fees. Invest consistently regardless of what the market is doing. Don't try to time it. Don't try to pick winners. Don't try to find the smart manager. Ignore the noise from financial media and advisors trying to sell you something complicated. The best investment strategy is boring, and that's exactly why it works. Fire any financial advisor who tries to talk you out of index funds unless they can show you 20+ years of data proving their recommended strategy beats index funds after fees. The math is simple. The results are clear. Index funds win because they don't try to be clever. They just capture the market's returns at the lowest possible cost. That's not exciting, but it's effective. And when you're trying to build wealth, effective beats excitement every single time.